crazy in the mornings. Do you guys believe that? Do you guys believe that I'm telling the truth? Do you guys believe I look myself in the mirror and tell myself that I'm the unstoppable force and the immovable? Put a 1 if you think I'm telling the truth. Put a 2 if you don't buy that shit for a fucking second. Yo, Mike said 1. Yo, fuck you, bro. Yo, damn, y'all think I'm really out here talking to myself in the mirror? Easy in the mornings. You guys think I'm really out here talking to myself in the mornings in the mirror? This is the level of confidence that the team has in me, right? I said talking up them shoulders, really. Yo. The only thing I'm warming up my shoulders for, James, is to put this fucking industry on my back. That's what I'm doing. I'm doing hot yoga. I'm doing deadlifts in the morning, just trying to prep my back to throw the fucking game on it and carry this thing upstream. Sorry, I just got to make sure that we're live. Okay. Not cool. Yesterday's trade was so beautiful. So beautiful. So we're 7 minutes out from the market open. This is actually good. This thing could just continue to print bullish the whole day and might not give us a re-entry opportunity until Jerome Powell speaks. So for now, gonna put this off. So it's in Amsterdam, but it's hosted by the Federal Reserve Bank of New York. Am I bugging? This is May 14th, right? Yeah, May 14th. Huh. So we can't watch live. Wait, this is Governor Lisa Cook. First off, Michael Barr. We gotta talk about conflict of interest here. Talk about that later. We're not gonna go down that rabbit hole. Or maybe we will. Let's see. Vote live. See if we can find this stream. The foreignbankers.nl. Oh, that ought to work. They want me to log in? Yeah, you thought I'm gonna go on YouTube here. Yeah, see how much work it takes sometimes? Just to
And it's great to see so many of our members here now, as well as the partners that we work together with throughout the year. And it's quite the occasion to convene here today at the Royal Tropical Institute, and tropical it is, by the way, having Jerome Powell as chair of the Federal Reserve of the United States of America as a very special guest and as our speaker. Over the past decade that the FBA has been organized.
Let me know how the audio is coming out, yo.
event,
Audio's good. This guy's voice is gonna make me want to hit something, but we're gonna make it through this. I'm gonna see what Jay Powell has to say. I don't think Jerome's speaking till 10, so I might just like let this ride until I see Jerome on the stage,
knowledge,
and then we can get into some trading here.
wide range of topics.
Welcome. Okay, welcome. If this is your first time on the streams, welcome back. If it's not your first time on the streams, this is the Chart Addicts live trading streams every New York session, almost. I know the last few days we were doing members only streams. Yesterday, did we make money? Of course. First, we had the rejection that we wanted to catch, but it happened pretty quick. So we anticipated a pullback to the 18,158 level. That's where the market very generously came back, wicked right through the 18,158 level, ended up going a bit lower down to 145. So like 10, 15 points of drawdown, and then straight to TP2, where now we had the second massive retest today. This big wick rejection after the PPI news that broke through all of the weekly lows. And I think this is going to be our new weekly low. So I'm waiting for a pullback around the same region to 145 so I can go long on NASDAQ. We're here waiting while we're watching the foreign central banks, what is it called? The Foreign Central Bankers Association meeting, hosting Jerome Powell here, and Klaus Knott. It's over in Amsterdam. They'll be talking about the global effects of central banking policy. And of course, this is a pretty big topic right now. After Jerome Powell has indicated the potential for 0 rate hikes in 2024. How do no rate hikes affect global cooperation between central banks? We're going to find out here in a little bit, and hopefully they ask some tough questions so it's not just a giant waste of time. Mike, the fact that you said that you think that I stare myself in the mirror and look myself in the mirror and talk to myself is crazy. I am not doing that. All right? I'm great. I think I'm great. Do you guys know why I think I'm great? You guys know where my unreal sense of confidence comes from? Doing stuff, right? Not talking to myself. I know, all jokes aside, a lot of people look at the manifestation, look at the stuff in the books about law of attraction and manifestation, and they're like, oh, I gotta talk to myself all day and look myself in the mirror. And that's true. You do have to reiterate and just repeat your goal over and over again so that every action, circumstance, relationship, interaction that you have throughout your day brings you one step closer to your goal. And the more that you reiterate your central focus, whether it's getting rich, whether it's being happy, whether it's having a big family, whether it's getting the new house, the new car, if you reiterate that goal, you will step into that reality eventually, because every action, circumstance, person, situation is going to bring you closer, because that's what you're looking for. Cool. All that aside, you don't build confidence in trading by talking to yourself. You have to build experience, and you have to, how do I say this? You have to be deliberate. Okay. You go through stuff. Here's the difference. A new person will say, I'm a consistently profitable trader over and over in the mirror until it happens. I tell myself I'm a consistently profitable trader 100 times in the mirror, but I also add this little caveat at the end. I'm a consistently successful and profitable trader because, and this is where the fun starts. I'm a consistently profitable trader because I have a system that I know is effective and I know works. I follow my plan to the T and I don't break my rules because of how I feel that day. Because I've put in enough time and hours to know when not to trade and when to trade, and I don't feel the pressure of needing to be in the market. So now you start to get to these anchor points of why you are successful and why you're a confident trader. Then you're not going to feel like you're lying to yourself. Because if you're not in shape and you tell yourself, I'm in shape, I'm in shape, I'm in shape, at some point your body's going to be like, no, the fuck, you're not. Right? It's going to be very hard to keep lying to yourself. So stack confirmations in your favor so you can continue to build genuine confidence that are anchored in experiences and anchored in success rather than anchored in delusion. You guys like that one? Yeah. Little education pun you had top. A little quick education. All right, members, let's do some quick maths here. Okay, in the members chat, phase two direction was what? Phase two direction was what? Mike says 10,000 hours to master anything. You're damn right. It takes 10,000 hours, and trading is harder than playing the clarinet. Okay, so if you think you need 10,000 hours to play the clarinet, imagine what the fuck you need to be a great day trader. Now, clearly, some of you guys had a great teacher and a good system to start off with, so you didn't have to unlearn a bunch of stuff. So maybe that 10,000 hours will come down to like 4 or 5,000. But still takes time. What's the direction for phase two, members? Come on. Okay, there we go. James got it. So that means that's the real direction of the trend. So to answer the question earlier, why we're not selling, like, come on. Really? The next person to talk about selling NAS in the chat is strike one. Okay? Unless we see a massive bearish shift, if you see two bearish candles and you ask about selling NAS in the chat, I'll make you do sprints the same way a coach would if you miss a pass in a game. All right, Chris, good morning. Tech Grid today. She loves Irvin. What a fucking YouTube name. Mohan, good to see you. Sherry, good to see you. Good morning. Danny, good morning. Danny, Fagali, Chris, Felix, everybody, we got a full house today. Good stuff. But you guys see the Model 3? Am I just tripping or am I bugging? It says RIP to the sellers. Bro, I try to tell him, Mike. I try to tell him. It all started with Josh McGinnis, bro. Please tell me Josh is on the call today so I can roast him. No, no, Josh.
Yo, am I catching a stray here, Roy?
Oh my God, there he is, brother. I've been trying to, I can't talk shit about you behind your back. So I've been trying to get you on these streams for like 2 weeks now so I can roast you. For the one sell you tried to take like a month ago at this point. The joke's fucking, now I just look like a weirdo remembering the joke from a fucking month ago. Right? I've been trying to have you on the streams because I can't roast you behind your back. Obviously, that's fucked up. But now that you're here, the fuck were you thinking trying to sell NAS? Can you give me?
No more sells, man. No more sells. I know now.
It's called growth, everybody. That's called emotional maturity. That's what's happening. Who else was trying to sell NASDAQ this morning? Which one of you was it? Abdon, it wasn't you, was it? Yeah, one of y'all. We had a man down situation this morning. We had a fallen soldier. Felt like I was in Saving Private Ryan. I was like, fuck, do I leave him? I was like, it's kind of cold today. Do I just leave him? I know, no man left behind. Fuck. I gotta go get him. And there's always going to be that one person that says, yeah, but Roy, I made money on a sell. Right. My cousin once took a sell once on a trade. I don't remember. And he won. Everyone's always going to have a story of making money on the short side on NASDAQ. If you do it consistently, guess what's going to happen? The market's bullish, so you're not going to win. Now, if you have a very clear take profit system and you understand that the market's bullish, and you know that you're not swing trading this thing, that it's going to be like a small move, you know how to play the counter trend trade, have at it. I'm not your boss, right? You can do whatever you want. For most people, trading with the trend is going to make you money, and trading against it is going to crush your account. It's that simple. You're like, well, Roy, let me find out for myself. All right, have at it. Or you can just take my word for it. The trend is your friend. Not all cliches are there for no reason. Sharbil, sabah al khair. Could you check gold? No. Once it breaks 18,240 and hold, then buy it. Oh, we got a trend chaser over here. He said once it breaks above 280, that's when you want to buy it. My buddy wants to buy it at the fucking extension levels here at the target. He wants to buy it at the sell zone right here. Right? Thank God we don't take advice from people on social media, everybody. And if you do take advice from people on social media, then I hope this is a fucking learning lesson. I hope you burn your hand on the stove bad enough, look down and see scars when you do that goofy shit again. I'll tell you something. Should I even mention his name? God, I'm really trying to turn over a new leaf here. I'm going to turn over this new leaf until I have a bad day, and then I'll fucking blow the lid on this thing. So I'll be respectful today. I was following a very important trader, quote unquote, And he used to put up free trade ideas. Now, my dumbass used to take those free trade ideas as if they were signals or as if they actually, like, they had to play out because this guy was so good. 4 or 5 winning trades later, I felt like I was the man. I'm full margining, not a single withdrawal, blew it all in one trade. And then people started giving the guy shit for losing trades. And so he became very spiteful, kind of like the Joker, and basically just started giving out fake trade ideas all the time so people could lose. And I was the guy. Right. And so I blamed that person for about 6 to 7 months because I lost all my money. I was miserable. And then one day it clicked. I was watching a Jerome video and he was like, "It's all your fault." Right? Everything is your fault. It's 100% on you. That thing that you think is not your fault, still your fault. So that kind of woke me up to realize, all right, I didn't lose because of this person giving me these fake signals. I lost because I was stupid enough to take signals from somebody online, to put my family's future and my own financial future in the hands of a random person on an IG post, and like they give a fuck about my future. You guys understand? That's why I had to learn how markets work for myself. I had to become self-sufficient because the risk of giving that power to somebody else, I was never going to do again. The fuck out of here. I'm never taking a signal, a fucking recommendation. I don't even use indicators. I still count my money when it comes out the ATM. I don't trust anything, right? And that's how I've been able to maintain a consistent level of quality control, of just not making big mistakes that I have to deal with later. You guys understand? So if you're following people on socials, it's good to learn. It's good to kind of try to piece things together, but you should learn how to do things for yourself so you can be the most effective and you're not putting your family's future in the hands of someone who honestly just might be too busy or might not be there in the future. Okay, we're still waiting for Jerome Powell to hit the stage. Doing good. Huge, huge milestone for us today, by the way. We hit 1 million views in the last 28 days, which is how YouTube kind of tracks our metrics and the numbers. So I want to say thank you guys so much for 1 million views last 28 days. Looking forward to doing that weekly. If it's your first time on the stream and you're one of the thousands of new subscribers on the channel, make sure to hit the like button and make sure to turn on notifications so you know when we go live. Typically, it's every morning right at the open of New York session. So if you're just hopping on, market had some pretty quick movements following the producer price index news that released right at 9. So tomorrow we have CPI dropping. Today PPI is dropping. Very busy news week ahead. Let me show you guys. So Jerome Powell speaking in a bit. We have that recording, or not the recording, we have that stream pulled up, and we'll be waiting for Jerome Powell to speak at the Foreign Central Banks Association in Amsterdam. Tomorrow we have core CPI, we have core retail sales CPI, annual CPI and retail sales, as well as Japanese preliminary GDP, but that's on the side there. But we have CPI, core, and retail sales dropping for monthly and annual, all on the same day. Not much happening on Thursday except for the ECB financial stability review. Remember, I went on this whole tirade about the financial stability review. Not stable, not good. Euro trash. All right. Quick reminder of what we talked about on Sunday. Let me save you time. All right. Financial stability review. It's about as stable as a 7.2 magnitude earthquake. That's about as stable as the European economy is going to be. Not going to go into the tirade again. We all know that Euro sucks. Just had to make sure I remind you. FOMC, Federal Open Market Committee member, one of the kind of the key players inside of the Fed. Member Waller is speaking at the Standardizing Technical Committee 68. Don't care. Okay. I read five words. That was just enough words to realize don't matter and don't care. I didn't even care about Jerome Powell speaking today. But come on, how can Jerome Powell hit the stage and we don't have that pulled up? This is what I'm talking about. Some people watch podcasts on YouTube. Some people love video. I watch Jerome Powell live meetings because I'm weird and that's it. Is it going to help me make money? No. My levels are already marked off on the charts. It's either going to hit or it's not going to hit. I'm just watching the Jerome Powell thing for fun. I just want to see what Jay Powell has to say. Is it going to help us make money? No. Good morning, Abdon. Good to see you. So what you recommend we do, the real OG? What do you recommend you do? About what? The part where I spent 20 minutes talking about learning a strategy for yourself so you don't put your family's future in the hands of someone inconsistent. Was that not clear enough? Do you guys want me to spell it? Don't be a follower, be a leader. Well, don't be a follower, be a student first. Everybody wants to be a leader and this and that. Then you're going to have the blind leading the blind, the followers leading the followers. Okay, so first, don't be a follower, be a student. But after you're a student and you know what you're talking about, there you go. My brother, I used to be AMG, but I changed my name. You changed your name from AMGG to She Loves Irvin? Bro, I swear, bro, please tell me your name's at least Irvin. We had this dude on here telling me like, oh no, that's my nickname. And it was like two first names, neither of them were his real name. It's right in front of you, OG. Should have been in buys. I know it happened way too quick. I was out on a run. As soon as I walked in, it already happened, but I'm waiting for that pullback, but don't worry about me. Don't worry about me, baby. Money is money, my baby. I'm just fucking waiting on my setup so I'm not reckless just dumping all my ammo into the market. I got to have some cash on the side. What trading platform is this? This is TradingView, my brother. I recommend you take a master class. That's today's advice. There it is. It says it is Irvin. All right. If you told me your name was like Steve or some shit, and you got She Loves Irvin as your name, that was going to be 2.5 strikes instantly. You skip all the strikes straight to 2.5, and then you're about half a message away from going to the gulag. Like whoever was making the toys joke the other day. That dude's on 2.75, right? That dude's on 2.75 strikes, hasn't even got on the stream yet today. That's the gulag's waiting. AMG was better. Tell him to go back to AMG. Hey, I agree, brother. Yo, Irvin, AMG was better. He said, I see 18, 155 support, 232. So 155 support. Okay, beautiful. We're on the same page. 232 consolidation, 240 break setup. Oh, you're talking about a fucking consolidation break setup? Bro, you're talking about a breakout trade, like a break and retest? Please say yes. The real OG. Are you talking about a break and retest trade? The real OG. But if the answer is yes, you're going to have to change your name. Irvin's going to have to change his name just because I feel uncomfortable. And real OG, you're going to have to change your name to be accurate. You're going to name yourself the real Baby Pips trader. From the real OG to the real Baby Pips. Talking about a break and retest. Holy. All right, here's what I'm going to do. If you're a new trader, I'm going to put you on game, which means I'm going to give you guys some serious gems here. If you're learning a strategy where they tell you that the market will break an area of consolidation, come back, and then let the resistance become support, and then it's going to continue like this. If the strategy teaches this, just go ahead and eat glass or something. Okay, why? Because it'll be more fun than losing all your money for the next 3 years. Like this is what I love. I love the fucking, you go online and you see forex trading patterns and they see a wedge. Oh, the wedge is going to go like this. Bro, in what fucking universe does the wedge just fall out like this? This is how a wedge fake out, actually, this is how a wedge really looks. Okay, it's going to be wedging. It's going to fake in the right direction, then come down, and then continue. Okay, it's going to crack both sides. Same here. You're welcome. Real sauce. Don't buy breakouts. Imagine the people buying up here off the break and retest on the smaller time frames. But you're selling, I mean, you're buying at resistance. What universe? I read Warren Buffett's book. I'm not a fucking genius. I read his book. He said buy low and sell high, right? Now, if I'm not mistaken, if this is low and that's high, you're talking about buying high. Buying high. Yeah, high on crack. Why would you buy it at resistance? I don't understand. Okay, I think the playbook is good. The real OG, I know I gave you a hard time, brother. You're probably not even looking for any of that. But you also probably were, and you're not going to admit it because I definitely did, you know. Yeah. Morning, Roy. Jerome Powell in 4 minutes. Well, you telling me like I don't know? Like I'm not highly anticipating Jerome Powell speaking? No, she was off the yeah, making this presentation. Oh my God. No, she made this on Prezi. I like this. But there's too many words, man. There's too many things going on. That's the thing about economists and doctors. Like, I'm pretty sure we'd have a cure for most shit if they didn't make the presentation so damn complicated. In case you guys don't know, fun story. I used to work at the National Institutes of Health, which is the federal government agency that deals with infectious diseases and finding cures and research for some of the rarest diseases. I worked for Anthony Fauci and Dr. Collins, like in the same office, like building, because there's over 40 different buildings at the National Institutes, and they're all like they have the virology labs and they have the you know they have the cancer institutes and the cancer labs. I was in that Dr. Collins, Anthony Fauci office, and they'd basically just be doing meetings like this all day, trying to pitch different research topics to get funding the whole time. And Fauci and Collins get to choose where the money goes. So people would always just go and research and present stuff that they thought would get money, not stuff that they thought would be important for the world or stuff that we could have a cure for. But it was, could we even get this funded to start doing research? So they would stick to the stuff. I saw one on vaping. That was probably the most interesting and relevant one I'd seen up there. Said, you sound Asian sometimes. What the fuck does that mean? What does an Asian person sound like? Is that racist? Guys, was that racist? So was we saying all Asian people sound the same? That's crazy. You can't say I sound Korean just because I said 안녕하세요. Can't just say that. Saying all Asian people sound the same.
Yo, chill out, Roy, bro. Come on.
You know I got you, bro. I'm putting on for my fucking Koreans out there.
My man said 안녕하세요. I'm weak.
안녕하세요. It's like I speak Arabic. I'm like, what, bro? You think I'm fucking Arab just because all Arabs look alike? Just hit him with some shit like that. He said that's racist. Oh no. Yeah, I mean, replace the word Asian with another race. Let's see if it's racist. Just keep replacing it with a different race until it sounds racist, and let me know. Let me know if that was racist or not. And look, I don't care, right? Have at it. You want to be racist? Fine. Make it funny in the chat. All right. We're not sensitive over here. We're day traders. This is not the Weenie Hut Jr. If you're gonna be racist in the chat, it better be fucking funny. You understand me? And you gotta be an equal opportunity roaster. You can't actually be racist. That's crazy. Said, is that the man, the myth, the legend, Ryan Karstens in the chat right now, gracing us with his presence? The answer is yes. And it's fucking wild. Great day, Roy. Great day. Right back at you, Rich. We got Jay Powell about to hit the stage. Don't care what this dude says, but waiting on this here. Okay, here's the retest that we've been waiting for. I wonder how many people are going to be selling today. Probably a good amount, right? Yeah, they're going to be looking for that wick fill in it. It is the 886 on the top side, though. If we go top to bottom, come on now. Let me fix this up a bit. Come on now. So this would be a pretty good zone right here at 155. Beautiful consolidation range right here. There he is.
Venue with
to Amsterdam. It's a pleasure and an honor to be here. So the U.S. economy has been performing very well lately. We had growth last year of just over 3%, quite a strong year. And it's driven by a number of things. I would point to a very strong labor market where you've got rising employment, you've got rising wages, so disposable income, consumers are spending. Generally, households are in good shape financially. They're not over levered. And so we see a good picture. Consumer spending has held up very well. As well, business investment has been strong. Businesses are seeing opportunities to invest, and that has helped. I would also point to a fairly large influx of immigration into the country over the past couple of years. And those people are joining the labor force. We're experiencing still a labor shortage in many industries. And so there are jobs and they're going to work and they're consuming. So that's also boosting growth. So overall, a good picture looking at the data so far. The labor market is very, very strong. It was, I think, overheated a couple of years back. And what we've seen is it coming back in gradually into a better balance over the last couple of years. And now I think if you look at a broad range of data, you could say that the labor market is about as tight as it was before the pandemic in 2019. And that's good. Wages real wages are now positive.
Benson, yep.
And unemployment has been below 4%.
Josh, yes, you have to be equal opportunity roaster. Okay, if you're just ripping on white people, for example, then you're just fucked up. Now you actually have a problem. Like, you got to get some emotional maturity there. They'll ask me like, Roy, do you hate Arabs? Roy, do you hate black people? Roy, do you hate white? Yes, I hate everybody equally. Fuck all of you. You understand? Equal opportunity. That's how we're doing it this year.
We're 27 consecutive months, something that hasn't happened in a half century. So labor market very strong. And all
right, I'm not going to get myself in more trouble. I'll leave it there.
Rebalancing so that supply and demand of workers is coming back into balance, which just as we would want. Inflation, it's worth starting with the fact that on a 12-month basis, headline inflation got as high as 7.1%, is now down to 2.7%. Core inflation got as high as 5.6% and is now at 2.8%. So it's down by half. That progress, though, really, particularly the second half of last year.
Yeah, we might not get this retest.
Was notable for its lack of further progress on inflation. We had higher readings in the first quarter and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work. If I turn to the outlook just for a second, I would say we expect 2% or better. We expect the labor market to continue to be strong, but
I'll answer all questions after he's done talking, but I am taking notes here.
And I expect that inflation will move back down on a monthly level, on a monthly basis, to levels that were more like the lower readings we were having last year. I would say my confidence in that is not as high as it was, having seen these readings in the first 3 months of the year. So we're just going to have to see where the inflation data fall out. And I'll stop there with the economy. Thanks.
Thanks very much. We'll be digging into some of that later in the discussion, but now I'd like to turn to President Knot. Could you maybe give us a little bit of a sense of how you judge the state of play in the Eurozone and here in the Netherlands?
Yeah, I think the state of play in the Eurozone is not entirely comparable to that of the US. We just came out of more than a full year of economic stagnation. Now, luckily, the signs of recovery are clearly there. We started off the new year much stronger than we had expected. And if you look at the soft indicators, that recovery is expected to continue.
You all know how I feel about Europe, correct? I don't have to reiterate myself. So while he's talking, you know what's going through my head, right? The whole time. It's just going in my head, just bullshit. That's the bullshit meter is on because the European economy is not stable. You could see it on Jerome's face. Let's get back to the show.
Recovery, of course, you can say on the one hand, the economy has proven to be resilient. We've went through quite a number of shocks, monetary tightening, unprecedented, and yet we did not really go into a recession. The sacrifice ratio of the disinflation process that we had to go through was virtually zero. Unemployment did not budge.
These are the people fucking the world up, by the way. Is the modern monetary theorist.
not as abundant as it was in the US, and that is clearly remarkable. Now, I think there is a multiplicity of factors behind this growth differential, but if you allow me to single out the two most important factors in my view, first of all, fiscal policy. And this was not only about the size of the fiscal stimulus, it was also about the design of the fiscal stimulus during the pandemic.
Interesting.
In the US, there was a choice for temporary layoffs, income support, and then rehiring when the economy reopened again. Well, that means that a lot of labor reallocation took place, and we know that such reallocation is very productivity enhancing. But in Europe, we chose a different approach. We chose an approach that was focused on job security. The governments essentially took over the wage bills of the firms. And as a consequence, we froze the supply side of our economy for a couple of years. Then during this period of stagnation, there was a lot of labor hoarding, which means that we have gone through a number of years where there has been hardly any labor or, for that matter, capital reallocation. So we have not enjoyed these efficiency benefits of reallocation as much as the US. And secondly, the economic impact, the negative economic impact of Russia's unjustifiable invasion into Ukraine were, of course, also much stronger on this side of the Atlantic.
Unjustifiable. You guys see that little fucking dig right there?
Fuel importing area. So it meant that this was a very strong negative terms of trade shock, and this terms of trade shock of which we are recovering still also today. Now, on inflation, I think the picture is that I'm increasingly confident that inflation will decline towards our 2% target during the remainder of the year. This is mainly on the back of goods and food price inflation that is coming down. Services inflation has been resilient for a while, but we're now also seeing the first signs of improvement there. And that has everything to do with a slow but gradual moderation of wage growth, which is quite essential, I think, also going forward in making an assessment of inflation risks. But all these developments clearly point.
Bro, this is hurting my soul. Every single thing he's saying is so destructive. First off, wages going up is only going to make the inflation problem worse. Because as we always talk about, if people are getting paid more, they're going to pay more. And if they're going to pay more, prices don't come down. So their inflation problem is going to keep getting worse. They have not been resilient through anything. They just printed a shit ton of money. And they've kept artificially low interest rates this whole time at the destruction of all of their other trade partners who really needed them to get their shit together and raise rates to avoid a bigger collapse in the future. An unjustifiable war with Russia. Did we forget the part where Ukraine was about to join NATO and it was a strategic risk for Russia to even have a border nation that was in NATO? So everything that this dude's saying from start to finish is complete bullshit, and he should really leave the politics out of this, because I know Jerome Powell has no interest in being caught up in European bullshit politics.
Well, I do believe that inflation is probably less persistent in the euro area than in the US. And that leads me then to conclude that if we manage to continue on this track, if the incoming data continues to validate this development, that it will be appropriate for us to gradually take off.
Okay, you can keep talking, but let me just go through gold real quick. Gold, we broke through the first magnet zone, of course. Super secret magnet indicator, the greatest indicator in the world, only found here on the Chart Addicts live trading stream, undefeated, undisputed, broke the 2353 zone. Now we're retesting that level, potentially coming back to the 2323 support from last week for another re-entry. And then 2400 is my longer term target for gold. So wait for a pullback. 2400 is my target for gold. USD JPY is in profits from the trade 2 weeks ago, where we had that break below the lows and then a recovery, inverted head and shoulders. Beautiful, beautiful trade. Just hit the 50% fib about halfway through the move. So half of the trade is done. This was about a 2.3 to 1 R so far. If it hits the final take profit, 4.8 to 1 R on that trade. Bitcoin, expecting that move down to 40,000. So we're still headed down. Mark my words. This is going to be one of my greatest call outs of my trading career. And once we hit the 40s to 45,000 range, we're going to start to pick up a bunch of altcoins at the floors and buy them at discounts. All right.
Producer price index reading just a couple of hours ago, and I would say it's actually quite mixed. You know,
He's talking about the PPI print that just released.
backward revisions, and you know, we're of course disassembling it, taking it apart, and looking at it. And I think markets and analysts are looking at it as I wouldn't call it hot. I would call it sort of mixed. But in terms of the overall picture for inflation, I think you have to go back to last year where we had.
Jerome always lies when he's on stage with Europeans. I don't understand this. He just doesn't want to make America look bad. The release this morning was 0.5%, which means that prices for producers went up 0.5% month over month. That's unsustainable. For God's sakes, we're trying to bring inflation down, and this thing is going up at an aggressive rate. This is not good.
And we didn't, and then it really arrived in 2021. So that was a big part of this, was just the reversal of distortions really to both supply and demand. The second thing is just restrictive monetary policy, and restrictive monetary policy cools the economy and makes room for the supply side to heal but also lowers demand and ultimately lowers inflation.
No, that's the president of the Bank of Netherlands, Klaus Knot.
And the question you ask is inflation going to be more persistent going forward? I think, and that would essentially mean that we've gotten the supply side gains that we're going to get, and now it's down to lower demand, which would take longer and potentially be more painful. I don't think we know that yet. I think we need more than a quarter's worth of data to really make a judgment on that. We know that there are still businesses still report that there are shortages and labor shortages and things like that, which are now being addressed. In addition, even when the shortage is alleviated, there should be lags before that shows up in economic activity and inflation. So there may be some more there. I don't want to give up.
I don't want to keep interrupting Jerome, but do you guys see the target from yesterday at 18,234 that never got hit yesterday? The TP3 gets hit today, but after it grabbed liquidity from the downside. That's why we take partial profits, because if you took this trade, this wick here, you took TP1, TP2, then you would have made money. If you had held all the way through hoping for TP3, you get crushed first and then it hits TP3. You understand? So this is why we take partials. The live example here.
Incest here. I mean, you referred to it briefly then. But from Edin at ORV, he asked, do you entertain the possibility that return into the 2% target will not be possible with the current level of the Fed funds rate?
Yeah.
I think, as I just mentioned, I do think it's really a question of keeping policy at the current rate for longer. I think by many measures, the policy rate is restrictive. The question is it sufficiently restrictive? And I think that's going to be a question that time will have to tell. Entertain the possibility is, that could be a very small probability, but I have said that I don't think that it's likely, based on the data that we have, that the next move that we make would be a rate hike. I think it's more likely that we'll be at a place where we hold the policy rate where it is.
And is there any particular component of inflation that concerns you? A lot of people in the US have been focusing on housing and that segment, but is there that, or is it something else that?
So we think of it in three buckets. The first of which is just goods inflation, and goods inflation was negative for 25 years, mildly negative because, of course, globalization, and many goods were manufactured elsewhere and shipped at lower costs. So that, I think, is performing broadly as expected over time. We had very high goods inflation at the beginning of the pandemic because of the supply chain issues. That came down a lot, and I think we expect that. Housing inflation has been a bit of a puzzle because current rents have been low. Current rent increases have been low for some time.
Oh, we got to talk
but they're
about
not
that.
showing up. That's not showing up in rollover leases and in owner's equivalent rent. So, and I think what we've learned is that the lags between a decline in market rents and it showing up in the measured inflation for housing services is long. Their lags are longer than we thought. But as long as market rents don't go, as long as they're going up at very modest levels, it will show up. It's just a question of when. I think our estimate of the lags is there.
If you're a renter in the chat, let me know if your rent has gone up in the past 2 years.
Happen. In terms of the biggest part of it is
Put a yes if your rent has gone up in the past few years. Put a no if your rent has not gone up in the past few years.
the index. And, it's less interest sensitive. It's very sensitive to wages and that kind of thing. We had made some progress there. Particularly if you look at the market-based aspects of it, but that's the one that I think may take the longest. At the same time, it doesn't need to go to 2%. It wasn't at 2% before the pandemic. You need the three of those to come out in some way that they're at 2%. And I'm confident that we will get there.
Excellent.
I want to remind everyone that 2% target was a very random thing that started in the late 90s. And then we ended up adopting it in 2012 as a random number. There is no scientific, mathematical, financial, or economic basis for that 2% number. It's just like somebody had said they wanted to target 1%. I think it was Amsterdam actually said they wanted to target 1%. And so America just added a 1% buffer and made it 2%. It's a completely arbitrary number, by the way.
Of consideration when trying to understand why the US and Europe seem quite different economic beasts at the moment.
So I agree with all of the factors Klaus laid out. I would add we were probably also benefiting from a sort of strictly accounting GDP standard from new workers coming in to a large extent. I think the issue really is, and this is an issue that that the European economic policymakers are very, very focused on right now, is over the longer run, Europe's productivity growth has been about half of the US. And so ultimately all you've got is hours worked, and that's largely a function of population, hours worked, and then output per hour. That's going to be your economic activity and growth. And so productivity is, really the thing that can enable living standards to rise over time. And, there are a lot of theories on why that might be. I think from an American perspective, I would tend to point to the more flexible labor market, and also a more fully built out set of capital markets, which is parts of which are very focused on funding early stage innovative companies. So it's not just a bank centric system. We've got a very highly evolved financial system. That may be another factor.
Yeah. So plenty of other reasons there that are worth mentioning, I think. Turning back to you, President Knut, you gave a pretty clear signal, I think, that we're going to see a move in June. But a lot of the questions that people have put to us today have, stressed this point of, usually there's been this sense that the ECB has been following the Fed, and it's raised a bit of a question mark as to what degree can the policies of, the two major global central banks, with apologies to the Bank of England, how much divergence can we really see? So to what extent do you feel constrained by what the US central bank does, and would you perhaps be reluctant?
This is the ultimate question. How does what the Fed does affect everybody else?
Stand pat and leave rates as they are for the foreseeable future.
Look, I think if you talk about monetary policy of big central banks like the Fed and the ECB, that monetary policy always takes place in a global context. I mean, our markets are interwoven to a large extent, etc. At the same time, we both have clear domestic mandates that look on an economy which may be 10, 50% open, but it means at least 85% closed economy. So much of our inflation is actually being triggered still by domestic factors. So what we simply need to do is construct our own inflation outlook for the euro area. And yes, Fed policy is, of course, one factor that has an impact. And if you think about international spillovers, the first things that comes to mind is through the exchange rate. If the Fed were to run a tighter ship than we were going forward, then probably that would lead to some dollar strength and euro depreciation, which of course leads to additional imported inflation. But at the same time, you will also have a spillover effect through global financial conditions. Bond yields internationally are also moving in tandem. If you look at the last few weeks and months, bond yields in the euro area have gone up significantly without there being a true euro area reason for doing that. It was just the spillover from the US. And that effect is, of course, disinflationary. So if you look at the two effects, it's not so clear which of the two will dominate. And it's therefore also not so clear whether the developments in the US will really have a meaningful impact on the inflation outlook in the euro area. I don't think it will change the direction of travel in the euro area that much.
So you'd be willing to cut in July too?
Well, we've been saying all along that we follow a data-dependent and a meeting-by-meeting approach. And I keep repeating here, it is essential what is happening in the labor market in particular, because services inflation is still the main remaining driver of inflation in the euro area. So we will simply have to follow the data as it comes in, both on underlying inflation trends, the labor market, etc. And that's why there is no commitment beyond June. We will just follow a meeting by meeting and a data-driven approach. And data, when it comes to the labor market, it's really about the comprehensive assessment of the labor market. It's too simple to just look at sort of contractual wages. Contractual wages are coming down. But one of the problems now is that we have negative productivity growth in the euro area. We had negative productivity growth in Q4. In Q1, again, it seems as if growth in employment exceeds growth in GDP, which means that probably next week we will get another negative productivity growth number. And that means that unit labor costs are actually still going up. And then the question whether profit margins are capable of continuing to absorb these unit labor costs, that's something that we really have to assess over time when we decide on future steps. So nothing, no commitment whatsoever, open mind for anything beyond June.
And just to turn back to the issue of US inflation for a moment, even though there's this sense that we did see a remarkable drop of inflation last year because it was, just so aggressive the year before that there is this sense that, there's still a public perception that prices are very high. How difficult is it to really feel as though you can keep credibility at times when trust in public institutions is under siege? And that's from...
Well, she ain't holding back any of the hard questions.
So I think for central banks, credibility is kind of everything. And we only earn that one way, and that's by, achieving our mandate for the benefit of the public over time. And also I would add, a part of that is sticking to our knitting. Don't take on politically fraught issues that are really not our mandate. Do your job and explain as best you can what's happening in the economy.
Well, put W. Powell in the chat.
Post-pandemic economy has
I fuck with Powell, man.
Everyone. I wouldn't single out any single central bank or group of forecasters. It's just been many things that were not supposed to be able to happen have happened. Nonetheless, we've made real progress on inflation. We're far lower than we were. I would say the risk that at the beginning we were very concerned that the very high inflation we saw might be quite difficult to bring down without a kind of very significant decline in employment and weakening economic activity. That didn't happen. That's just a great result. I think people are unhappy. You mentioned people are unhappy. That I fully appreciate that. And a big part of that, I think, is go to the store. Prices are high. You tell people inflation is coming down and they think, I don't understand that. The price of all the things that I buy hasn't come down. So, they're not wrong. I mean, they're suffering, particularly people at the lower end of the income spectrum are very hard hit by inflation from the start, which is why we're so strongly committed to restoring price stability and keeping it in place as long as possible.
And just to turn back to Europe now and to the Netherlands in particular, we're sitting in a venue here that's really testament to the power of trade for good and ill.
Oh, man.
In an era of de-globalization, when we're seeing daily headlines about tariffs, and how does the Netherlands as a small open economy, and indeed the Eurozone as a very trade dependent region, really thrive?
Yeah, that's a difficult question. I mean, it goes beyond saying that this is a development that is absolutely not a positive development for the euro area, and that we watch with a lot of concern. Now, fragmentation is there. The train has left the station. So, we have to think about sort of the ways that it can manifest itself and what we can do to try to best redress its consequences. there is a sense that international business is actually to some extent more resilient to political fragmentation than we have been thinking beforehand. So that international trade is a little bit like a river that sort of tends to find its way, even if some obstacles are being raised here and there. But of course, the fragmentation, it impedes the diffusion of technology across borders. So that means lower productivity growth everywhere. I would also not underestimate the limitations that it puts on our capacity jointly and internationally to solve global problems. In a fragmented world, suppose we had a global financial crisis again, like in 2008, 2009. It would be much, much more difficult to get the G20 around the table and to agree on a concerted remedial plan as we did in 2008, 2009, think about climate change, etc. What can we do about it? Well, I think in Europe, there is still a lot of untapped potential to at least strengthen our internal cohesion. We're not.
Mike, that's why every time I see somebody talking about sales, bro, the thing is the higher it gets, as it gets to the extension levels, that's where the retracement's going to come in and it'll be quick. But people get burned so bad trying to guess where that high is that by the time it hits, they're barely breaking even.
And so we are missing out on opportunities to strengthen international trade, or sorry, inter-European, I should say, trade and integration, economic as well as financial.
Would you have anything to add on this topic? I know it's something that's featured in the Fed minutes about the links perhaps between trade barriers and inflation and so on. Do you see it as a risk?
So this is a very, very hot political issue, not just in the United States, but everywhere in the world. And
US 30 looks
policy,
like
of course,
a
not
buy
the
right here.
Fed. So, I mean, we, as I mentioned a few moments ago, I think we need to resist the temptation to just have opinions on all different kinds of economic policies, as fun as that might be. You know, the elected government has to deal with these things and they have to deal with the public on them. And they've given us really important assignments. And I think we need to honor the decision not to give us that.
And I appreciate this is also an awkward topic, but it is deficits in the sense that the national debt is forecast to rise by the Congressional Budget Office quite substantially over the next 10 years. Does that make your life trickier as Fed president, Fed chair rather too?
I don't think it's not that it makes my life more difficult or the Fed's work more difficult, but I think it's you know, utterly non-controversial to say that U.S. fiscal policy is on an unsustainable path. Not that our fiscal position itself is unsustainable, but the path is unsustainable, meaning that we have full employment and we're running big structural deficits, and it's, we're going to have to deal with this sooner or later, and sooner is a lot more attractive than later. I do hear from elected people on both sides of Capitol Hill and in both political parties that they do understand this. Mm-hmm. And I think you mentioned the Congressional Budget Office. I think everyone should be reading the things that they're publishing about the U.S. budget deficit and the path, and should be very concerned that this is something that elected people need to get their arms around sooner rather than later.
Yeah, this is just such a tough one.
A lot, you've noted a lot that these supply side benefits that you thought might come in 2021 or 2022 did actually arrive in 2023. Now, what sort of benefits from the supply side do you think we could see in 2024 and beyond?
So I think we probably have realized most of the reversal of the pandemic supply side effects, but not all of it. But I think we could get more sort of the final parts of the supply chains really getting sorted out. As I mentioned, the surveys of businesses, they still say there are shortages. They still say that they have a hard time hiring people, for that matter. So I do think we're still getting very substantial numbers of people coming to the country and going to work. Let me add, immigration also not a policy that the Fed works on or has opinions on, but I'm just giving you the straight economics of it. People come in, they can get a work permit. They are getting work permits, and they go to work and they're paying taxes and they're creating economic output, and there are millions of them. So it's alleviating the labor shortage that we had in the industries that really had it the worst. So I think all of that, it probably helped at the margin a little bit, in cooling the labor market off. It's both supply and demand, but we think at the beginning, in the longer run, it should be neutral on inflation, but in the short run, it might have been positive. So I think that's a factor too.
And just to kind of turn to these like broader demographic trends, there's been a lot of talk in recent years about how they will impact inflation, whether they have some sort of impact on R star, the kind of, you know, the Goldilocks level of interest rates in the longer term, one might say. I mean, how do you think about these kind of longer term demographic trends and other factors and how they're going to influence where you see this kind of magical Goldilocks neutral rate of interest? So the R star, for those of you who aren't, you know, central bankers who read every word of every story Claire writes about us, R star is really a longer run concept. R star is a neutral interest rate that would neither push up on economic activity nor bring it down at some hypothetical future time when we're at full employment, we're at 2% inflation, and there are no shocks hitting the economy. So think 5-6 years down the road, there's this sort of nirvana out there. Its relevance.
Beautiful pullback right now. Beautiful pullback. Prices getting back into our entry zone.
In an FOMC meeting is we're looking at, you know, the broad effect of the things that we're doing on the economy. And we're asking ourselves, is policy tighten up? Is it too tight? We're looking at what's happening in the economy. We're thinking about lags. And it's not a debate over the level of R star because that's a longer run concept. Now, and the argument is made that R star.
All right, US 30, you want to see it come back down at least to 39,400, back to the Asia lows before taking a trade. But it could come down as low as half of this wick. That's what makes this so tricky. So you want to wait for it to dip below the zone. You're going to get a lot better entries below.
Population, bigger deficits, higher. All of that could push up the new what is a neutral rate. And I think those are the interesting debates to have. But ultimately, we're not sitting around wondering what the longer run neutral rate is when we do policy. When we make policy, we're thinking today, is our policy delivering what the economy needs to move it toward the mandates that Congress has given us: stable prices, maximum employment.
So would you divorce it? I mean, I think why this has come into focus, if you like, is because, you know, now that, you know, cuts are being considered in some parts of the world, at least there's this sense in which people are thinking, how low will rates go? Would you see that as part of the kind of R star debate, or would you want to divorce the two factors of this current cycle and where R star will end up being?
I think the R star debate runs in the background, but again, it's a longer run concept. You could, you know, if you wanted to think about a shorter run R star, that would be more relevant. But that's not the way we think about it. We think about the effect of the things we're doing on financial conditions more broadly and on the economy, and how is it affecting the economy and why, and, you know, and all of those things lead us to believe at this time that policy is restrictive and that it looks like it will take longer for us to become confident that inflation is coming down to 2% over time.
And how is this debate occurring around the table in Frankfurt at the ECB about longer run interest rates, or even, you know, where are we going to end up? What's the rock bottom for this cycle?
Yeah, I mean, that's of course a difficult question to ask because there are so many moving parts here. But what I would say is that if you look at the likelihood or the likely nature of the shocks that will hit us in the future, we came out of a period in which we had globalization, which was a slowly moving positive supply shock, ever more goods for ever lower prices coming from the rest of the world, which meant that for almost 10 years, we continuously had to approach our inflation target from below. We had a low inflation problem. Going forward with fragmentation, with aging of our societies, in my view, it's more likely that the shocks hitting our economy will actually be of the nature of negative supply shocks, not positive supply shocks. And if you think that through, that means that probably we will have to approach our inflation target more often from above than from below. And that probably suggests that we are not, that at least I don't regard it very likely, that we will move back to the time in which we had a continuous sort of a fairly persistent low inflation equilibrium with very, very low interest rates. We probably have to, on average, run a slightly tighter ship because of the nature of these shocks that are currently relevant to our economy.
And just to come back to something that I think has been kind of in the background here for quite a lot of the discussion about high interest rates taking possibly a while longer to have the desired impact on some pockets of the economy. Now, how do you see that? Is this a legacy of this very low interest rate era? And how do you really address that when it comes to monetary policy? That, is there just going to be this lag from now on that didn't exist, say, relative to pre-2008?
So I think if you look at the bigger picture, we've seen the labor market's a good place to see this. You've seen demand for workers cooling off pretty substantially. The ratio of vacancies to unemployed people, for example, has gone from more than 2 to 1 to now 1.3.
We're gonna have to do a whole stream about the effects of immigration on the labor market and how it's been affecting this data, because everything looks great on paper, but we got to talk about the real logistics of it.
I think that tells you that policy is probably restrictive. I think it's also fair to say, though, that the U.S. economy is different this time for a couple of reasons. One is that people financed themselves into very low rate mortgages, and now they won't move because they would be moving into a higher rate mortgage if they did, and they would be throwing a lot of value away. The same is true of businesses, many of which, as indeed you would expect, have termed out their debt. And so they're not feeling the effects of interest rates. So it may be that policy is hitting the economy not quite as strongly as it would have if those two things were not the case. Notwithstanding that, I think the overall picture still is policy is working. It's weighing on spending. It's weighing on interest sensitive spending, and it's certainly weighing on the labor market. It's a question of restrictive policy. Or as I mentioned, our policy is the highest it's been in quite some time. The rate is, at 5.25% to 5.5% is high relative to recent history. So we think that it's probably a matter of just staying at that stance for longer, and that's how we're thinking about it.
I mean, you note about housing and about the standard model in the US being I think I'm right, the 30-year mortgage is kind of the standard mortgage product. I think here in the Netherlands, flexible rates are quite more fixed rates.
Yes, absolutely.
So fixed rates are quite common too, but I imagine with shorter
10,
shorter
15,
duration.
an average mortgage, I think, has an average maturity of like 16 years. Of course, that's a little bit endogenous because of the low interest rate period held for so long that, of course, mortgage holders tended to extend the maturity. So now, lately, it's been coming in a little bit, but still, we have a lot of fixed rate borrowing in the Netherlands, and that has, of course, also mitigated the impact of the monetary tightening, which has been stronger in those areas where there is more variable rate borrowing. But in general, I would say 85% of all financial intermediation in the euro area runs through the banks. So when you look at monetary transmission in the euro area, you have to look at credit. And credit growth has more or less come to a halt. As a consequence, we increased policy rates by 4.5% within 14 months. Credit growth came to a halt. That was a feature of the policy, not a bug. And credit has been flat for quite a while. And now we're also beginning to see the first signs of life again. Now that there is an anticipation that our next interest rate move will be a reduction of rates. You also see the first signs of recovery in credit. So in that sense, I think this is more or less how you would expect monetary transmission to take place in the euro area.
And how much of an issue has that been for you in the US, where we do have this, where capital markets play a far greater role, and where, for reasons that were never quite clear to myself, the turn of the year, the markets were predicting, 6 interest rate cuts by the Fed, and pricing credit off the back of that, and there being quite a big, quite substantial growth in lending and refinancing over the first couple of months of the year. How much more difficult does that really make your task that the banks aren't as big a vehicle?
Well, for what it's worth, it's a minority of intervention, but banks are still important, and particularly for small, medium-sized businesses that don't have capital market access. And credit has been tighter for some time now, particularly in the wake of the turmoil we saw earlier last year. But still, credit growth has been modest, and that's another sign of tight financial policy. So that's part of the picture. I think the fact that we have capital markets are so important for many consumer loans of various kinds wind up in the capital markets or securitized and are not held by banks. It's just that it's a very healthy credit machine for people, but they're feeling these higher. Those are short-term interest rates. I think that the ones that are longer-term interest rates are the ones where they're not feeling it, and that's really mortgages, and that's companies that have turned out their debt. I think other forms of consumer debt are short-term, and the surveys show that people think it's not a good time to buy durable goods like cars and washing machines, and the reason is it's a floating rate loan at a very high level.
Absolutely. And when you look at the banking system as a whole, we've seen some jitters, I think, on both sides of the Atlantic, but on the whole, it seems both systems are relatively stable despite quite substantial rises in interest rates. Has that surprised you at all? Maybe first to Chair Powell and then to President Knott.
Has it surprised? Not really. Our banks are particularly our large banks are strong, well capitalized.
So he's at large banks
competitively, globally. They're in I think one of.
Notice how whenever they ask Jerome Powell about the banking crisis, he always mentions the large banks are stable, but never talks about the medium, the local and regional banks, because those are the ones that have been getting hit with the interest rate sort of the issues with interest rates because of the debt that they're holding, or some of the commercial real estate debt, or the bonds kind of duration risk that they've been holding. The big banks are always going to get bailed out by the Treasury. It's the regional banks that are going to be having problems.
We had a period of turmoil early last year, and we acted pretty quickly to stem the turmoil and also to go to work as a supervisor and make sure that banks had good plans on liquidity, had capital, understood the portfolio losses that they have for longer run securities, and are in a position to understand and manage those.
Well, I think it's pretty clear that if you have such an unprecedented rise in interest rates in such a short period of time, that this constitutes a massive shock to the financial system. So when we were sort of in the process of tightening, of course, this was sort of enhanced monitoring, an area for enhanced monitoring. Now, I think we can say so far, so good. I entirely agree with Chair Powell that the core of the financial system has held up quite well. And I think this is in part, I think the success of the financial reform agenda that was rolled out after the global financial crisis under the aegis of the Financial Stability Board, which was very much focused about stronger capital, stronger liquidity, stronger risk management at the banks, which were at the core of the financial system. And that has clearly paid off. Now, there have been some idiosyncratic accidents here, the second-tier US banking system, Credit Suisse, but I think there were idiosyncratic factors behind it, and the banks that arrived into trouble in the US were not even part of the Basel III arrangement and the financial reform agenda. But I would say so far, so good. The question marks today are much more in the non-bank financial intermediation space, where we have seen a couple of quasi near miss accidents, I would say. The Dash for Cash, the LDI, the Archegos, the commodity traders in February 22. So these have all been pockets of vulnerabilities where you saw a combination of excessive liquidity mismatches combined with pockets of hidden leverage that we were unaware of before. And that is now also front and center of the work program of the Financial Stability Board, much more the NBFI space. Of course, we have to learn the lessons from the few banking failures that we did see, and that is continuous maintenance. But I think if you were to ask me, my main focus is more on the NBFI space than on the banking space.
We'll come back to Credit Suisse because I know that's a topic that you've spoken about quite a bit, and a few of our audience have got questions on that. But non-banks, would you share that, that sense in which they're the big lurking danger in the financial system right now?
I guess I would say it this way. In the US, non-bank participants by non-banks in lending activities, for example, has been growing very, very fast. And it's a fairly new thing. And in many cases, whole markets are being now taken over, or now majority for non-banks. And so our job is to monitor that very carefully, because I'll say a couple of things. One, there hasn't been a downturn yet. You worry about very fast growth in anything. It just kind of raises financial stability questions, and you wonder, is it a bubble? What will happen, and will it deflate, and that kind of thing. And so you want to be watching it carefully. I will say though, it's different. You know, some of the we've spent a lot of time looking at it. I just point to a couple of things. One is, many of the lending structures are not subject to run in the way that banks have traditionally been. The funding tends to be from limited partners who have their.
By the way, y'all, if you guys are sitting at home saying, wow, this is taking a long time, this does take a lot of patience, et cetera, this is trading. We're not really getting paid to click a button. We're getting paid for the waiting part and to sit on our hands until the market presents the best opportunities. So this is trading. When you're waiting for the setup to show up, you're waiting. When you're waiting for price to get to your optimal entry, you're waiting. Once you enter, you're waiting for price to get to your target. So we're getting paid for the patience. And patience is nothing more than finding out what to do in the meantime to keep yourself busy.
So there's plenty of monitoring for us to do there. It's not obvious to me that at this point that it's a net loss to financial stability, but I would say our jobs are to monitor it very carefully and thoughtfully, and understand the implications.
Just to return to the topic of Credit Suisse, we had a question submitted ahead of the event. In your keynote speech at the 7th Annual Conference on European Systemic Risk, you talked about events surrounding Credit Suisse. What can the Foreign Bankers Association, to which we're speaking today, and the Netherlands Bank learn about the collapse of the Swiss lender?
Well, I guess the main thing one can learn about the collapse of Credit Suisse is the huge importance of governance within financial institutions, because it is pretty clear that the events that led to the failure of Credit Suisse were not sort of a classic lack of capital, or let's say too much credit risk relative to the capital. It was management failures, there was outright fraud, there were misinvestments, there was misbehavior, even at the top of the institution. And if you have a series of governance failures at an institution, it will lead to an erosion of confidence. That erosion of confidence will lead to deposit runs, which, by the way, already took place.
Yeah, if anyone took that US 30 buy, you are in. You are in right now. That was a good entry. Right below the 39,400, right? 39.80, 86. That was the golden zone right there.
And are there any questions about AT1s and the treatments of those particular instruments that you think can be drawn in the Dutch context?
Yeah, of course, there was a case where AT1s have been completely written down. So I think it behooves us to look a little bit deeper into this issue, why the AT1s were drawn down, whereas equity was not fully written off. This was, by the way, completely in line with the contractual provisions of the AT1. There was just that not all investors had really read the contractual provisions, so they pretended they were surprised by it. But I think from every case, I think we should try to draw some lessons. But in this case, at least, it allowed the authorities to write down 16 billion Swiss francs, which was helpful to generate the interest of UBS to actually take over.
And now turning back to you, Chair Powell, we've got a very nice question here from Yojan from ICBC, who asks, during COVID, the Federal Reserve applied high levels of monetary stimulus to further raise asset prices and support growth. Bloomberg called you Wall Street's head of state. as a reflection of how strong your actions were on asset prices and how profitable your actions were for Wall Street. How does that make you feel? And how do you look back at this?
She ain't
with the
holding back
benefit of
a single thing today.
It makes no point of contact with the way I remember those days, so whatsoever. So I would just say this: if you put yourself in the place where we were in March of 2020, no one knew how long it would take to have vaccines. No one knew whether millions of people were going to die fairly quickly, or how long the economy would remain closed, or was it even going to be possible to reopen the economy if it had to be closed for a year? What was that going to look like? So I think it was so uncertain that I came to the view, and my colleagues did too, that we really needed to use our tools in ways that we hadn't before, because I would never have been, if things didn't work out, I didn't want to, if we had to go through a really deep, lengthy downturn, I would not have to explain why we didn't do that. So we did. And what happened is we announced these very aggressive, vigorous programs to support markets that we had never had to support before: the municipal market, corporate debt, these were red lines that we said we'd never cross. But the thing is, when we made the announcements, the markets healed themselves. So we made very, very few loans. We had something like 6 trillion in lending capacity. So
it's one of the Swiss banks. It was the National Bank of Switzerland. So they have UBS and then they have Credit Suisse. And both have kind of just been having tons of fraud and management issues all the way from the top levels of the CEOs. They had 3 CEOs in a row that each one committed a different fraud, and they all got fired for a different kind of fraud. It's a sketchy bank, dude.
Anything you do differently in retrospect?
And if you took a tester entry on this,
differently in the
you're
initial
definitely in profits
response, I think we
the NASDAQ.
did very well, and I think that the world continues to benefit from the strong response that we took, and we really avoided an awful lot of a bad tail risk there that could well have come due. Again, I would say on inflation, when inflation kind of unexpectedly arose in the first quarter of 2021, I think we're going to need to, I've tried to resist reaching, conclusions about that episode until, it looks so different now than it looked a year ago, for example. All the progress we made in 2023, I think we're talking about it in a completely different way now. I think 2-3 years from now, we'll be doing the same. So I don't want to try to learn lessons, in kind of in the middle of the story.
Sure. Yeah, it's very fair. And another question here that's just been submitted from FBA, who asks, is Chairman Powell confident about the degree of independence of the Federal Reserve in relation to the executive branch of government? Do you think you have the powers that you need to defend your independence?
Yes, without question, I do. I think when
big statement from Jay Powell.
I talked to elected representatives in both political parties in the House and the Senate, and I think there's very strong support on both sides of the aisle, on both sides of Capitol Hill, for an independent Fed. I think people do understand that we're just there to do our job on a non-political, non-partisan basis. Nobody's perfect. Everyone makes mistakes, but the Fed is doing the absolute best we can with the tools that we have and the understanding of the economy that we have. I think that is very broadly understood and supported on Capitol Hill. So I'm less worried about that than the sort of things that have been in the press lately might suggest.
The same question to you. Do you feel as though the ECB's independence is well enough enshrined?
Oh, yes, I think the ECB, has one of the strongest statutory independencies of maybe all central banks in the world. And I just, let's zoom out just for one moment. I mean, this inflation shock that we had, if you compare it to the previous inflation shock of the same magnitude, which was the 1970s, when we didn't have independent central banks, the main difference why I think now we have a credible prospect of getting the problem under control within, let's say, 3 or 4 years. There you go, Mike. Awesome. While in the 1970s, it took 10, 12 years, and the disinflation was so much more painful. The sacrifice.
All right, guys, I got to hop off. I got a few meetings I got to run to. Great to see you this morning. I'm still waiting for this pullback. So if you took the tester entry, I would definitely secure some partials or close the trade if you get the chance. Could it continue running from here? Of course it could. I'm personally going to wait for this pullback down to the Asia lows just to see if I can get a really good entry and put in a full position here. But if you took that tester, definitely hold something if you can. Overall, a good trade. I'm seeing a pullback for sure. So set your alerts. What I'm going to do is set an alert at the Asia highs. Set midway at neutrality of the Asia range. Set, and then I'm going to try to go as close to the lows of Asia as possible, a little bit above the lows of Asia, because I don't want to miss the 88.6 trade. So maybe a little bit higher. Okay, so my alerts are set. I'm going to get notified if price comes back inside this range, and I will take another entry. This is going to be the real entry, I think, where the market makes a very aggressive bearish push down. And I think 152 would be that ideal spot here for that real push. Do not chase price up here. That's just about the goofiest thing you can do. That's just not even the question. But yeah, I'm thinking it's going to break this wick at least to the Asia lows, and then maybe even lower before we have like a real rebound. That's what I'm going to be looking for. Set your alerts so that you guys can take this trade as well. And I'm going to catch you guys tomorrow on the live streams. US 30 went nuts. Yeah, it did. Oh my. Oh my. A quick 93 points in about 20 minutes. That's what I'm talking about. All right. Well, congratulations. If you made money, drop a like. If you didn't make money, hopefully you learned something. So drop a like. If you haven't already subscribed, make sure that you do on your way out. If you guys see the videos that we drop, give them a feel. Give them about a minute. See if you like the videos. If you like the videos, drop a comment, hit a like. Appreciate you guys. NASDAQ Masterclass, June 14th. If you guys want to learn this strategy for yourself, link is in the description. Get your money up, not your funny up. Happy and safe trading. Peace.